So hello and good morning. Very warm welcome to the presentation of the first half year results of 2024. I think most of you know the format by now, which we're doing digitally. So Dr. Schmidt, CEO, and Rudolf Weichert, CFO, will illustrate the results and talk about the strategy. And in the end, you'll be able to ask questions. You can do this via Zoom. Either you raise your hand and I unmute your microphone, or you can type in a message into the chat.
Just wait a minute.
So basically, after you typed in the message into the chat, we read it out one after one. The presentation we are showing is on our website, and you can download it, but we altered the slides a bit for the fluency of the presentation. So now I think I hand over to Dr. Schmidt, who will start with the intro.
Good morning, ladies and gentlemen. It's our pleasure to host you for our earnings call for the first half year of 2024. And Rudolf Weichert and myself will lead you through our presentation, and we are happy to answer questions later on. Before we jump into the presentation, just let me make a few remarks to set the stage, so to say. When we look back on the second quarter, first of all, I remember our annual shareholders meeting in May. The meeting decided on a dividend per share of €1.20. And if we add this up together with the share buyback program that we executed also in the second quarter, we already distributed a total of €56 million to our shareholders. When we look on the performance of our portfolio companies in H1 2024, if I put it in a nutshell, I want to say that the development is in line with the expectations in the whole. And I mean, this also shows when you compare the actual figures that we published today with the consensus that is on our website also. I think what we see a significant impact on segment engineering from the general reluctance to invest in the industry. We see good performance of segment infrastructure, despite the persistently weak conditions in the construction industry. And we see a segment materials that is weaker due to increased price pressure and reduced volumes. Nevertheless, when we look on the EBIT margin, we see an increase as compared to the first quarter of 2024, but also as compared to the third and fourth quarter of 2023. When we look on earnings per share, we are at 1.21 euros per share, which is well above last year's value of 0.8 euros. We have a strong free cash flow, which we'll comment on later. And this gives us the freedom to execute the acquisitions that we have planned for the year 2024. Obviously, and we'll get to that as well, we had to revise our guidance because the assumed positive trends that were built into the budget for 2024 did not materialize. And now the portfolio companies look on the second half of 2024 that appears to be weaker than originally expected. Having said all that, let's jump into the presentation. And since all of you, I think, are very familiar with the business model of INDUS, I'll jump that section and I will directly give you a short update about PARKOUR Perform. Update PARKOUR Perform. I think everybody knows PARKOUR Perform. You know about the 4 initiatives that we have. And I will only highlight a little bit the strengthening portfolio structure part and striving for sustainability. Here we go. As you well remember from, I think, our earnings presentation for the full year 2023, we have set ourselves an ambitious goal, and we plan to invest 70 million euros in M&A acquisitions We have a well-filled M&A pipeline, and we have attractive targets. And we are also about, I think, to conclude a few transactions I would even say in the next weeks and definitely in the next months. But when we look on what has happened already, so we have already executed 3 acquisitions. We acquired Gestalt Automation for segment engineering on the first level. This is this young company in Berlin that is focused on AE-based automation solutions for industrial applications. We are working on this acquisition. We are refocusing the business model, and I think it's in a really attractive market niche, and I think it's going to work out. Then we had 2 acquisitions on the second level. Hauftechnik acquired the remaining 50% of Gridcom. Gridcom is a manufacturer of passive components for fiber optic networks. That business is running very well, I think, and contributes also to the segment infrastructure for the first time within the segment. In June, we closed the acquisition of Colson XL. This was acquired by PCL, which is part of Horn Group. So the consolidation, I think, is as per 1st of June. So you do not really see any effect, neither in turnover nor in profit in the first half of 2024. But the transaction is closed and everything went as planned. Then finally, we put that on this chart. It's not really an acquisition because it was just the final acquisition of the remaining 15%. So if you look on the balance sheet, I think it's just a payback of a financial liability. But nevertheless, Kapitel Inc., which is also part of Horn Group, now belongs 100% to the INDUS Group. The other element which we see and which is very important for us is really internationalization, as we explained it already also in March during the earnings call for 2023. So we really have a strong focus on internationalization of our portfolio companies. And we're using the existing network that we have of portfolio companies that are already in another company, in another country. And we support other portfolio companies that want to go to this country with the portfolio companies that are there already. This is just happening, for example, with FSBF, a manufacturer of sealing materials, who is setting up a manufacturing location in North America and is strongly supported by Aurora North America, that is already a well-established manufacturing location in North America. Then we have support from the holding with training courses, marketing for marketing and sales functions, which is also pretty important for the small companies that we have to broaden their perspective and to help them to tap the attractive markets that we see in foreign countries. Obviously, we can support our companies also with legal and other support functions when they go to foreign countries. And what's very important, and you just saw that with Colson, we can also help our companies to grow with add-on acquisitions abroad. So this has happened in the past already. I just mentioned Kapitel Inc. in the US as well, and this will happen in the future. And also a couple of the hot acquisition projects that we have right now are also in this area of add-on acquisitions in other countries. So the package shall really help our companies to broaden their international network, to broaden their international presence in markets that are faster growing than the home markets for the time being. I think I can skip this one. Then if we come to the fourth initiative, which is driving sustainability, I just wanted to give the information for those of you who are using ISS ESG ratings. I think by now, for the ninth time in a row, we got the C+ rating from ISS ESG. That means we are in the so-called prime sector of the ISS ESG rating. So we continue to show the performance that is required for SET, and it's always also a prerequisite for our ESG-linked financing with promissory notes, right? Another remark I want to make is, for those of you who want to see more, we just published in July, by now it's our fourth sustainability magazine. We call it INDUS Sustain. And this one has a strong focus on social responsibility or social sustainability. So this is the S in the CSRD, and this is something that's also becoming more and more important also from the reporting point of view. And I think this is something that will reporting in accordance with CSRD will for the first time happen for fiscal year 2024. So we are setting up for that, and we are getting ready. Having said all that, I think I'll hand over to my colleague, Rudolf Weichert, and he'll lead you through the numbers now.
Okay. Okay, then let's jump into the numbers. What happened in the first half of 24? As you all know, INDUS is comprised of 3 segments, and I think we should have a brief look at the segments before putting it together for INDUS as a whole. And let's start with the engineering segment. I think first remark is there any change in the composition of the segment? And yes, it is, but Johannes already mentioned we have 2 smaller acquisitions, or 1 pretty small acquisition, to see Gestalt Automation closed in March, and the other acquisition is Colson XL as a subsidiary of the Horn Group, which is closed in June. So as Colson is closed in June, it has no real impact on the first half figures, as well as Gestalt Automation, which is currently in a stage of further development and a slightly negative number. So the impact of the change in the composition of the segment is not notable in the first half of 24, I would say. If we take a look at the industry trend in the segment, and according to the Association of Mechanical and Plant Engineering Industry, they always publish numbers for the whole industry. Then it's kind of a subdued mood, and Germany is not in a good mood as currently. So we have a decline in orders of 12% year on year at the end of May, according to the association. We have a drop in production year on year in the first 5 months of 7.2%. So it's really not a favorable environment. And if we put this industry trend and if we look at what happened at INDUS in the first half of 2024, then we see the following. So you can probably argue it's a little bit better than the industry trend. We only dropped sales of 5.2%. And you will also see that there is an overproportional decline in EBIT from 25.9 to 13.9%, and there's a drop in EBIT margin in the first half of 2024. This is mainly due to a different mix and composition of orders and products which have been delivered in the first half. As you can see, the price quality was not so good than in the comparable first half of 23. So a slightly negative price mix. And the other thing is, if you have a declining sales number, but specifically in engineering, you have to really keep your skilled and trained workers. So the impact, if you have declining sales and you really are focused on keeping the staff and your skilled workers on board, because you think it's temporarily, then this is what we basically see in the first half of 2024. You can notice that we have a margin of 5.2%, which is not very favorable. But if you look at the guidance we've already published for the full year, then you will recognize that the margin will improve in the next 2 quarters. Not as much as we originally expected, but we will still see an improvement in the next two quarters. So this is the sales and the earnings situation in the first half of engineering. And if we look at the order situation, incoming orders and orders backlog in engineering, you can see there's a slight improvement compared to the first half of 23. There's plus 2.2% in incoming orders, and the order backlog increased also slightly by 4.8%. And there's another metric you can also acknowledge. We have 403.9 million in order backlog. And if we go back to the sales slide, you see that we have 266 million sales in a half year or first half year. And if you compare that to the order backlog of 403 million, you can do the math and see that it's more than the half year of coverage in the order backlog. So it's well into the first half of 2025. So the visibility of this order backlog is pretty good. Price quality will improve, so that we expect an improved margin. So this is kind of engineering segment in brief for the first half of 2024. If we skip to the infrastructure segment, then the first question is there any change in the composition? Yes, there is, and Johannes mentioned it already. We have acquired the non-controlling interest of 50% of Gridcom. Gridcom was an at-equity investment, is now a fully consolidated subsidiary of Hauf, and will have an impact on sales and earnings for the second half of 2024. It has a minor impact already in the Q2 numbers, but it's fully consolidated beginning of March, so the impact is minor for the first half of 2024. It will be a little bit more in the second half. So that's the change in composition in the segment, and also their infrastructure. The industry trend is kind of also not very favorable, and there's a slight differentiation in the industry trends. We see commercial construction slightly picking up, but there's still very little momentum in the residential and public construction. So it's a little bit mixed, but residential and public construction numbers are really down. So you can see the price adjusted incoming orders for the first 5 months is minus 4.4% compared to previous year, and certain negative development in residential construction, minus 4%, and a little bit offset by civil engineering and commercial construction. So there's a little bit of a mix, but also not very favorable conditions. Having said that, let's take a look at the numbers in infrastructure. You see minus 5% in sales. That's basically aligned with the industry trend. But you also recognize that we have an increase in earnings from 25.1 to 29.7 million. And also an increase in the EBIT margin. So what happened there is that the companies had time to adjust and have cost very much under control, and really worked hard to adjust to this expected lower revenues. And they did that in a very favorable manner, so that we really see good cost control in the segment, and very favorable numbers. If you have read already the published half-year report, you will recognize that there is one positive impact mentioned, which is the sale of a non-controlling interest of 30% roughly in a Polish subsidiary, which has a positive impact of one-off positive impact of 2.6 million. But this one-off positive impact is also slightly offset by a, let's say, insolvency or bankruptcy proceedings of the customer in the Netherlands for a subsidiary. So this has a negative impact of roughly slightly above 1 million. So we have a one-off positive impact of 2.6 and a one-off negative impact of a little bit above 1 million. And that's also included. But if you take that out, it's still an increase in earnings and a significant increase in margin. So very favorable development there. overall sales trend more or less in line with the industry. Order situation, incoming orders slightly increased by 4%, and order backlog also slight increase. We can also say more or less the same, which gives also good visibility for the next couple of months. Not that far out as within the engineering segment, but still for the remainder of the year, pretty good visibility there. Last but not least, materials. No changes in the composition of the segment there. No acquisition, so it's like for like. Industry trend in materials, it's even worse than like in infrastructure and in engineering. It's a really deteriorating order situation in the industry. We have 7% less new orders from January to May. The industry has a slump in turnover and sales revenue from January to May, nominally below 4.2%, and in real volumes 5.9% lower. So also really not a favorable environment. What happened in our segment? We had minus 10% in sales, which is maybe slightly higher than expected, and also slightly decrease in margin. Not as much as we might have expected, but it's down from 11.5 to 9.4%. It's still close to 10%. So the adjustment made on the cost structure was more in line with our expectations, but was falling a little bit below 10%. And the EBIT declined from 38% to 20 million to 27.9 million. And we mentioned that in previous calls, we had a really favorable first half 23 in the materials segment with high price quality of orders and sales, high price quality. And there's now price pressure from the customer side and a decline in material prices, which really impacted the EBIT situation there, but still a margin of 9.4%. If we look at the order situation, incoming orders, minus 9%, it's not that favorable than in the other segments. And the order backlog also declined by 8%. But still, that gives us a pretty weak outlook for the remainder of the year, and that's what Johannes also mentioned, that we cannot or expect a very positive outlook. So, giving the whole situation, we budgeted a slightly better second half, and now we see that specifically also in the materials segment, the second half of the year will more or less stable where we are. Johannes just mentioned that, or I should mention, if you've read already the half-year report, we added a couple of elements which should make it more transparent and gives you better insights, because for the first time, we included incoming orders and order backlog for a rolling 24 months period in our report, and added some highlights pages and a key metrics page in front as the first page. So we did some changes to our report, which gives you more insights into the order situation for each segment, and probably that helps in making your judgment. Okay, so having said that, the development of the three segments, if we put everything together, then you see that in comparison, sales numbers for the segment, which I've just mentioned, minus 5.2 in engineering, minus 5 in infrastructure, minus 10 in materials. It's more or less aligned with industry trends, so we are not much different there, and definitely within the segments, different developments of EBIT. Engineering, as just mentioned, with declining sales, we try to keep the high-skilled workforce there because we think it's really temporarily great cost control in infrastructure, and also only a slight decline in materials. So that's the EBIT situation. It's different between the segments. Yes, and that's only EBITDA, but there's no no further impact there. If we put everything together for INDUS as a whole, then you've just seen -5%, or with two segments, and -10%, so gives a total of -7.2% for INDUS as a whole. Our EBIT declined from 84.9 to 64.1% in total, which is over proportional, but as explained, mostly coming from the engineering segment and a little bit from the materials segment. Going to some key metrics on the balance sheet, I think working capital is well under control. It's an increase of 5.8%. That is completely in line with expectations, because we have weak situation of revenues in the first half of 24. The increase of working capital is not that high than originally budgeted, but it's well in our expectation and gives a favorable impact on cash flow. We see that later. Investments also completely in line to our budget. 17.4 million property, plant and equipment, 18.2 million in the first half of 23. So we are completely aligned there. And M&A acquisitions, this 18.5, this is Gridcom, the 50% of Gridcom, and it's Colson basically, and a little bit of Gestalt automation there. And in 2023, it was the acquisition of Quick Bauprodukte, if you remember. So completely in line, no surprises there. Very favorable free cash flow in the first half with 41.2 million. It was 35.2 in the last in 23. But as you may remember, we had a one-off item in 2023. In January, we sold an office, a building, which was no longer needed for production. So we had a positive impact of 14.5 million included in the 35.2. So if we take that one-off item in 23 into account, then we have a really good increase in free cash flow. And the main driver is the working capital development, but come to that later. Net debt, also favorable development. You see an increase from 506 million to 565. But we were able to do a share buyback program. We paid the dividend. We decreased significantly our debt, and we financed the working capital. So this is also completely in line with our budget. Equity ratio slightly improved to 38%. You have to keep in mind that we have a share buyback program of 25 million, which accounts against the equity ratio, and we paid out the dividend already. So in the second half, with no dividends to come and with no share buyback program to come, this number will go up again, and we will expect it's going up to 39% at the year end, so that we'll coming close to the target ratio of 40%. Also favorable development there. Okay. Having said that, I think overall we have very favorable balance sheet KPIs in the first half. Net debt, equity ratio, free cash flow, working capital, all completely in line. Investments are in line, From an operational perspective, we would have expected it a little bit better than the first half, and it came in as it is, and we have some favorable developments in infrastructure, but we will think that the second half will not as favorable as we originally thought, but it will be better than the first half. And having said that, we'll come a little bit to the outlook of the INDUS Group as a whole. And I will not go deeply into it. I think you read on a daily basis the development of the global economy, the German economy, the European economy, and currently Germany is not in a good position due to various reasons. It's kind of behind Europe, and it's kind of way behind the development in the world. And that's why we focus on internationalization way more. So we have increasing geopolitical tensions. We don't know what happened there. So the overall situation is not very favorable, and especially not for Germany. Having said that, we have closely looked into the numbers for the second half. We did our forecast, and basically we had to adjust the sales. For each segment, for engineering, infrastructure, and materials, we will have slightly decreasing sales and EBIT impact accordingly. So we adjusted the margin slightly in engineering. Previously, we had 9.5%, or last year we had 9.5%. We now adjusted the margin, the margin expectation from 6.5 to 8.5. We keep the margin expectation for infrastructure from 10 to 12%, very favorable, and we kept the margin range for materials from 7 to 9%. So basically, because of the weak economy, what we originally thought in our budgeting process, that the second half of 24 will pick up way more. I think this is delayed, and then we will be better than the first half, but in a kind of slower mode, basically. Mm-hmm. That leads us to the INDUS numbers overall, where we adjusted our sales, as I already said, the EBIT number accordingly, the margin slightly from 7 to 8%, but we kept the free cash flow number. And the reason for this is because we will have lower operational earnings, but we will also have a lower negative cash impact from the increase of working capital. So we will have a positive working capital impact, and we also have a positive impact from lower investments in property, plant, and equipment. And these both impacts will offset the decrease in operational earnings, so that we believe that we will still can go with the target of above 110 million free cash flow, which is also at least a favorable KPI for us. Having said that, I will hand it back to Johannes and Daphne. Yes. And we're happy to receive your questions.
Master of ceremonies.
Thank you, Mr. Weichert, and thank you, Dr. Schmidt, for the presentation and the information just been given.
Yes, and now we go back to work to make things happen. Thank you.
Thank you.
Bye-bye.
Thank you.